Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist for Wealth Press. Today's Thursday. It's January 5th. Today is actually 29 years that I've been involved in the markets. Can you imagine that? 29-year anniversary. I can't believe 29 years went by so fast, but here we are. It's January 5th, 2023. I'm getting old. It's 8:03 in the morning. And as you can see here, the Dow's down 20 points while the Nasdaq is up a bit and the S&P is holding up by its short hairs, if you will. So just to give you some idea of where we are right now before we get into the fundamentals or the fundamentals, this is a 60-minute chart of a 1 month. So this is 1 month in the S&P 500. So I want you to look at the trading action that's persevered or has been actionable since about middle of December. Remember I say usually the market goes on quiet mode a week before the holidays and it ends the week after the holidays. Well, here it is. It started before the holidays, and I don't think we're going to get much out of this traction till next week, which is when institutions and funds come in, or maybe tomorrow, Friday. Sometimes they'll pick up. Folks will start coming back to work, but generally volatility and volume picks up the week after the holidays, which is the second week of the year, and begins a week before Christmas. So here you could see it right here. This is intraday data. So as you can see, it's been a very, very frustrating time trading this market because we have gotten absolutely nowhere. And I mean, we have gotten absolutely nowhere since the 14th. So for 20 days, the market has been just a chop shop. Now, if you look at this on a broader market, here's a daily chart of the same thing we were just looking at. So this is the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14 days. So what you're seeing right here is exactly the same thing that you're seeing right here. I wanted to just kind of blow it up to you. So if you're frustrated and thinking, hey, the market's just not moving, 100 points up, 200 points up, 200 points down, up, down, down. It's not because of the stock you're trading. It's because the broad market just hasn't gone anywhere. When I say anywhere, I mean, look at this. Look at this. If you want to look at the intraday, or if you want to look at it day by day, this is daily. Just chop fest. No directional bias, no movement, no trend, nothing. And this is not uncharacteristic of the time period. But this is not really a bullish sign, especially the fact that it's all happening below the 200-day moving average. So I wouldn't get too bullish just yet. Also, as you could see here, the bond market is not exactly rushing to make new highs again or bust out of this period. And after yesterday's announcement, the FOMC minutes, which I'll talk about in a minute, you could see that there's a higher odds of bonds going down from this point than up. Me personally, we're not going to sell bonds again till we see it oversold. I want to see bonds oversold. And once I see bonds not oversold, overbought. Interest rates oversold, bonds overbought. Once we see bonds overbought, I want to see the RSI get above the 70 level. Then we'll go ahead and sell it. Till then, we're just going to wait. We haven't had a losing trade in 2022, and we haven't had one yet in 2023. But my goal is to have 10 winning bond trades in a row. I think we're up to 5 now. So I want to wait for bonds to go a little higher, and if we miss it, we miss it. Let's talk a little bit about pre-market and what to expect. A lot of data coming up and some stocks you need to pay attention to. So Federal Reserve December meetings, which they showed, they're committed to higher rates. They're not shifting their policy at all, and there's some numbers that you need to pay attention to. So participants generally observed that the Fed maintained a restrictive policy for a period until inflation is clearly on path towards 2%. That's very, very important. The minutes bolstered fears of higher rates for longer as data pointed to a still tight labor market. Speaking of labor market, the U.S. Labor Department's latest JOLT report, that's the private report, said in November, job openings dropped less than expected, which is a positive sign, but that depends how you look at it. Remember, too good is weak, too weak is bad. So we're in a really weird mode right now. Compared to 10 million, giving central bank reason to stick to its campaign of monetary tightening. It's counterintuitive. On the flip side, manufacturing contracted in December to the lowest level since 2016, discounting the drop early in the COVID-19 pandemic. Now, this is also important because China reported about a month and a half ago that their manufacturing orders are down 40%. So the fact that manufacturing is down to 2016 is not a sign of a bolstering economy or a real strong anything really moving in the right direction. It's just kind of stagnant. Now here's what you need to know, and this is really important. So I show this to you every day or every couple of days. This is what's baked into the bond market, the Fed minutes. And as you can see here, U.S. futures have now priced in a 62% of a 25% basis point rate hike and 37% of a 50. Now, why is this important? I'll tell you why. Because up till about 2 days ago, the odds of going 0.25 was above 70%. It might have gone even, don't quote me on this, but it might have gotten even as high as 74%, and now it's backing off. And this number obviously was about 25, 30%, less than 30%. Now it's at 37%. So this is increased bearishness on the market because obviously if the Fed now has a feel that they're going to increase, if the bond market is pricing in a 37% rate of a 50-point basis hike, that's not bullish, that's bearish. So I'm going to keep you posted on these numbers. They come out every day, every other day. I usually do them in my morning report, but they're important. So keep your eye on shift between 25 basis points and 50 basis points. Don't be surprised if 50 points goes up to about 55%, which again isn't all that bullish for the market. Today, all eyes are focused on the ADP non-farm payroll change. It's coming out, I think, at about 8:30. They're looking for a forecast at about 150,000 compared to 127,000. We're also going to be having jobless claims. They're looking at a number of 225,000 compared to last week's number of 225,000. And I don't want you to get too excited about the initial jobless claims. And I'm not really caring about what the Fed said because, honestly, that number has been holding up really well. So here, for example, here's jobless claims. All of them are coming out within the next half hour, which is why I'm doing this now. But if you look at the jobless claims, the numbers have been very solid. They go up 5,000, they go down 5,000, but it's been around 220, 250,000, 230. So nothing really wild or crazy there, and the numbers have been holding on pretty well for quite some time. We're also going to have oil inventories, very important. Economists estimate the figure to be at 1.154 compared to 0.718 million. Europe, they started the year on a positive note, better than expected inflation data from Germany and France, which wasn't so bad. China, oh boy, China today closed higher amid speculation of an imminent border reopening with the mainland. Yeah, don't hold your breath. Economic data this week showed that China's manufacturing and service sector shrank in December. That's bad because that's the impact of the COVID. Stocks to watch. You got to watch Amazon. They're gaining about 2% pre-opening bell. They're cutting 18,000 jobs. 18,000 jobs or more, excess of 18,000 jobs. That's painful. And then T-Mobile said that their post-paid net customer additions were higher than expected. So keep your eye on T-Mobile. Those are the two stocks that are in play. And in terms of earnings, we do have some earnings today on some healthcare and some consumer staples. Constellation Brands, Walgreens Boots, Conagra Foods, and Lamb Weston. That's the medical stock that I really like. And also Simply Foods. I just noticed that in here too. So we are having earnings. This is early or real late, depending on how you look at it. But main earnings are still not dropping for quite some time. So don't worry about that. We also have today, which the report did not talk about, the international trades in goods and services. And that'll also show an impact on, or show how China's manufacturing and our orders have been moving along. The consensus, as you could see here, is like all over the place. Last time we had a deficit of 78 billion, then it came in at 75 billion. I'm hoping that the number is going to be below below 75 billion, means lower than 75 billion. 74, 73, 72, which means we're going to be moving in the right direction. Now, in terms of the bond market, folks, this is important. I usually don't go hourly. I usually go daily. But again, if you look at daily and if you look at hourly, they're doing the same thing. My suggestion to you, I would highly listen to what Uncle Roger has to say. Stay away from the stock market, from the S&P, until it breaks above the 3,900 level on the S&P 500. On the SPY, it's 390. Or on the downside, the 375 level, or 3,750 on the big S&P. On the Dow, let me give you that level on the Dow, because they're all congesting and consolidating. See that? Look at that. Let me go to intraday, hourly. Here, 5 days. Let me go to 30 days. Here you go. Same thing. On the Dow, that level is 33,400. To the downside, it's 32,500. So we've been in this 2,000 point range now for 2 weeks. On the QQQ, I'm assuming it's in the same ballpark. Let's just take a quick look here. Yeah, even tighter. You've got 270 versus, let's see here, 260. 270 versus 260. So be very, 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 very careful. Now, the overall sentiment, you've got 179 stocks breaking up and 49 breaking down. Again, I would be more cautious if the market was in a trending mode. In this breakout mode, with this consolidation mode, I think this number is going to gyrate, because a few days ago, just to show you an example, yesterday was 59, but breakdowns was 110. They're just moving up and down very, very little. So there's just not a lot of directional bias. Now, looking at the ETFs, which we need to look at, and it's really important to me that you follow my rules and don't trade unless you're day trading or doing those swings where you're selling here, buying here, selling here. This is just a intraday range. We're not day traders, so I'd rather we wait for a breakdown or a breakout above these levels, and I think that'll happen either tomorrow or next week at some times. I'm pretty confident that it will. But for the time being, today we got ETF that you need to pay attention to. Today is Thursday. Thursdays we do ETFs. So looking at the ETFs right now, industrial is leading. And if we look at the charts, I actually really, really like the industrial sector right now. And I think energies are going to come back. I think financials are going to come back. Healthcare is really stagnant. Real estate looks like it's making a comeback, a little bit at least. Consumer staples look like they can go either way. In terms of consumer discretionary technology, no. And communication services, I think it's going to back away. So my advice to you guys: industrial, energy, financials, healthcare. Consumer staples is coming off, but anything in these top 5 would be okay. But I really, really like industrial right now. And industrial is ticker symbol XLI. It's leading well right now. It's actually breaking above the short-term swing, which I'll show you right now, right here. It's looking like it's breaking above the 200-day, or wants to break above the 200-day. This is intraday, and it looks like it's in the upper end of the range. I would right now be looking for the, let's see here. Let's go a little further. Yeah, let's go to 71 days. Give us a little time. March expiration. It's trading at 99. Go here with, you'll find some open interest once we open, but go with the 101, 102. One of these two, 101 or 102, preferably the 101, closer to the money. It'll give you some market cap, but wait till we get some liquidity. Or if you want to not bid too much, go with something a little tighter. It'll open tighter, the 100s, but you'll have to roll these if you don't get out in about 14 days. I don't want to hold this over 30 days. So be very, very, very patient right now, because the market needs to show its hand. And right now, let's see, it's about 8:17. Let's just see where the futures are doing right now. Yeah, right now we're just kind of drifting. Now, folks, remember XLI ETF and the 101 strike price or the 102 strike price for either February, if you're going to hold for 2 weeks, or March, if you're going to hold longer. Now, I got something exciting for you, something interesting, something you need to pay close attention to. My newest strategy might be the best one yet. It doesn't use fundamental analysis or technical indicators. Instead, it focuses on a handful of patterns. It's a completely different way of finding entries and targets than what you guys are used to. One of the tests showed that 100% win rate on 146 stocks over 5 years of testing. Now, that's based on historic testing And I wouldn't expect that kind of win rate. 100%, come on, let's be real here. We're trading, not winning, right? Trading involves winning and losing. But I'm incredibly excited about what I've done so far. And these patterns can do extremely well regardless of what the S&P is doing. I mean, or in this case, what the S&P is not doing, which is very, very little, as you could see here. Instead, I'm focusing on small cap stocks, not Apple, not Tesla's. I'm expecting generational opportunities for smaller companies. And this is the best way, folks, this is the best way that I've ever seen how to trade them. You could see exactly what I mean by clicking the link below. You don't want to miss out. And again, follow the market, but watch this intraday price action and wait for it to break up or break down. It's just too consolidated right now. Again, follow the link below. You don't want to miss out on my code breakers. They're very, very cool. And I'll show you the pattern that had a 100% win rate on 146 stocks over 5 years. That's mind-numbing, right? I mean, that's just amazing. And comment below my video. Leave me comments. Send me emails. I want to hear from you guys. If you don't know where to find this link or this video, go to the Wealth Press YouTube channel and you'll see it below. I'll see you guys later. Have a great Thursday afternoon. Bye.